Good afternoon, this is Christian Thwaites from Brown Janikowski, Wednesday, January the 27th. So the market was pretty much flat today, but at 2 o'clock the Federal Open Markets Committee released its latest results of its latest meeting, and the market went from its peak down to its bottom. It fell off by about 2% for an unchanged movement on the day, but markets were expecting a slightly more bullish, hopeful outlook from the FOMC, and they didn't get it. What the Fed said essentially was that the labor market is unchanged. I think it's in fairly healthy mode. Take a look at this chart, however, and you'll see why we continue to feel that the likelihood of further rate increases in the first half of this year are unlikely. Back in December, the Fed said that the GDP would grow at about 2.1%. This is the latest estimates on how GDP now calculated by the Atlanta Fed, and you can see that this bottom line, the green line, is now sort of tapering down to less than 1% growth for the fourth quarter, and some of that spilling over into the first quarter. And remember, the Fed raised rates here. You can see the end of this arrow when what the estimate was and what the GDP now calculations were saying were about the same. So we've seen a big difference and falling off in growth. What does this mean for markets? We think that long-term rates will pretty much stay where they are, and we think that the 10-year rate will remain fairly underpinned and still a good investment. And I think as far as stocks are concerned, they have to get through a difficult earnings season. Some have been very good, such as Facebook after hours. Some have been a bit cautious about the economy, such as Boeing. But we do see, hopefully, that once we get through this quarter, we'll have better visibility on the S&P for the year as a whole. Thank you very much.